Hello, investment students. Hope everyone is having a happy Easter. We celebrated yesterday with a big dinner with relatives and kind of taking it easy in this very cold April day. Anyway, I hope everybody was able to get a little bit of rest this weekend, and we'll see how the stock market does this week. So, as I mentioned in week one, the market's really kind of been rattled by the war in Ukraine, big concerns with inflation, and bond funds have been really hit hard by concerns about the need to raise interest rates. Even I think on home buying, the 30 years up pretty high as an interest rate. But the Fed is going to have to make some tough decisions at the meetings, probably to start raising rates faster. That's probably been one of the criticisms of the Federal Reserve right now is they're not doing enough to counteract inflation. And there's been a lot of pent-up demand, and everybody is still wanting to go out and buy everything, regardless of their income levels. So that's been really driving up prices, and that can have wealth effects. So the stock market has been a little bit skittish, and the bond market. So, all right, for this week, you're going to continue with your weekly portfolio discussion post. Make sure to get that done for week two, and you're going to get a little bit more detail about some of the history of the stocks that you've selected. What is the risk with these stocks? How has they performed over a period of time? You may go back and look 3 years, 5 years, just kind of get an idea of, performance. What was the return on this stock? And again, past performance is no guarantee of future performance. Ultimately, any return on a stock should be based solely on the present value of future returns. So do they have a viable product or service? Do they have good management? Do they have some type of competitive advantage in the market that would justify where the current stock price is right now? So the chapter 3 is a lot about doing research, and there's a lot of places to do research these days. Even through your Baker University library account, you can have access to the Wall Street Journal or subject guides to find about industries, about particular firms. If you have a 401k account at your work, or you have one like through a Fidelity, you can have access to their research. So again, research is limited because it's based on past data, but they can also project out a little bit based on what they foresee, like through pro forma accounting statements and the market. But there's all kinds of variables happening all the time that can influence what's going to happen with that stock price and return. This chapter also talks about the Dow Jones Industrial Average. When the Dow Jones was actually started many years in the late 1800s, it was mostly railroad companies. There's 30 stocks in the Dow Jones Industrial Average right now. And what it is, it's simply all the stock prices added up and divided by a divisor. The divisor has to change because stocks split. So when you hear the Dow Jones Industrial Average, it is simply just an average, and you're just looking at that change in average. The other two big ones, common ones you see in the news, are called NASDAQ and the S&P 500 index. I'm a big fan of S&P 500 index funds. They're low cost. You don't have to overthink anything as an investment manager. And most people have a hard time beating that. Professionals have a hard time beating that S&P 500 index. Historically, over a long period of time, it's averaged about 10%, and professionals have a hard time beating that 10% return. So it's a good benchmark. But an index starts at a base year, and it looks how those prices have changed from that base year. So it's going to talk a little bit about stockbrokers. I remember I was a senior in college, and back in '91, I actually worked for a stockbroker in my internship. The guy wasn't the most ethical guy in the world. He was a former used car salesman and mostly targeted women to sell them annuity products that really weren't that great. It was a good lesson learned right away about what to do, not to do, getting financial advice. And these days, the stockbroker it still exists, but it's probably more for very wealthy clients. But a lot more people feel comfortable now doing their own research, and the cost associated with having a stockbroker is very expensive. It can eat away at your returns. So do you really want to pay someone to manage your account and take a 1% fee or up to 5% fee that can really eat away at your investment returns? Does that person really have a fiduciary interest in how you're doing? So but there's also going to be some things you're going to limit about different options. you can use. I have a Fidelity account I can put these things into, which they call like market orders to buy at a specific price, or market just to buy at the market, a limit order to buy or below a certain price to kind of help protect yourself, or a stop loss if you're worried about a price of a stock dropping. You could say, hey, if it's at $70 but it hits $60, sell it right away. So those have to be executed and fielded, and sometimes that's having a benefit of a stockbroker, but they could also be done electronically now too. So my thoughts are you don't need to be paying someone to do that, especially with the legitimate firms out there like Charles Schwab and Fidelity. But again, it's a question of, do you feel comfortable managing your money? That does take time. So that's why some people do pay someone, because then if you're an attorney or something else, a doctor that pays a high income, maybe perhaps I'd let somebody else manage it, and they're willing then to pay that fee, as long as they're making that money. Chapter 4 looks a lot at the risk and return. This is about our forum discussion. So you're going to look at some historical there. You can understand the idea of what like expected return is. If you've taken finance, you're going to look at the CAPM model, the idea of the risk-free rate, plus beta times the difference between the expected market return and the risk-free rate. So by investing in stocks, we know that they are riskier than other types of investments, such as bonds, or what is considered like a risk-free rate, like a treasury bill or note or treasury bond. But we kind of understand there's a premium associated with that. And a lot of it goes to what is your risk tolerance. Most individual investors are what I call risk adverse. They don't necessarily like to gamble, and I would say I'm a risk adverse investor too. Ideally, you want to be putting stocks into your portfolio that offset each other, or you have that's why I said the S&P 500. You're putting a broad range through a mutual fund. To try to duplicate that on your own could be quite difficult, but you wouldn't want stocks that kind of all move in the same direction, or as the saying says, to have all your eggs in one basket, to have all your money invested in one stock. Something bad happens to that company, you could lose your entire retirement savings. So, but one of the best measures, in terms of risk, is something you read about is like just calculating a standard deviation of portfolio. So by definition, variance is the difference of returns from an average, and you take a square root of that variance to get a standard deviation. So the greater the standard deviation, the greater the risk associated with that portfolio. So it's something to think about as an investor. How much risk are you willing to take on? And the other idea is that, hey, those that manage portfolios are going to try to reduce that risk. So the book is also going to talk about other types of risk, like liquidity risk, the ability to convert it into cash for an investment. It can just be business risk. What does it face? I was interested. I was telling my wife this morning, there was a restaurant in Lee Summit called Lee Summit Barbecue that had been there 30 years, and they decided to close it this week. And they said the reason they had to close was they just couldn't find staff to work it. It was a family-owned business, but I think they kind of just wanted to close it on a good note. But it's a great example of business risk right now. Can you get enough workers, and can you still break even? So it depends. And like I said, I think I posted an example last week. My son making close to $15 an hour at cheese signaling at Culver's. He's doing much better than I was when I was 16. So, but these restaurants and other businesses are competing against each other for these same workers. So that's making it a little bit more challenge. And if you don't have the workers, it's just you see some restaurants like McDonald's, they're not even opening the inside. They're just kind of staffing them on the inside, just let people go through. So it's even kind of changed the way we do things in our economy now. And we call that creative destruction in economics. I think it was Schumpeter that came up with the idea. But we'll continue to see our economy evolve, and we'll have new ways that business will have to deliver their products and services. So, but I think you'll find a lot of that chapter interesting. If you have questions about the technical aspects of it, do email me. But otherwise, I hope you have a great week. Again, do reach out to me via email if you want to talk to us Zoom. Just we can set up an appointment time. But I'm looking forward to getting some feedback to you on your week 1 homework, and I continue to plug away. for week 2 in the forum discussion with your portfolio tracking and your week 2 homework. And then continue to think about those projects, because they'll come here quicker than you think. So you want to make sure to start on that now to give you enough time to complete that common assessment. Have a great week, and we'll talk to you online.